Welcome to the debate. Today, we are diving into Lululemon, a company that has, I think we can all agree, fundamentally changed the game in premium athletic apparel. And for a long-term value investor, someone looking out over a, say, 10-year horizon, the real question isn't today's stock price. It's about durability. Does Lululemon actually possess a durable competitive advantage, an economic moat that's strong enough to defend its really superior margins against what is, a rising tide of competition? I'm going to argue that its innovation engine, combined with its retail model and global scale, provides a very robust, very defensible moat.
And I think I come at this from a slightly different angle. Look, the historical growth it's undeniable. Nobody's debating that. But I contend that this so-called moat is, well, inherently shallow. It relies far too much on the very fickle currents of fashion and brand heat, which makes it incredibly vulnerable to copycats and, frankly, aggressive new competitors. The slowdown we're seeing right now in their core U.S. market, plus some real signs of financial stress, it suggests to me the brand's premium status is a lot more fragile than many people are willing to admit.
Well, the durability thesis has to start with their core advantage, which is proprietary innovation. Lululemon isn't just a clothing store. They operate much more like a specialty materials science company. Their whole design philosophy, this science of feel, it's all about creating product differentiation through, complex tactile performance. That's what gives us fabrics like Luon, Everlux, and Nulux. This R&D investment is the engine that allows them to maintain these exceptional unit economics. I mean, when a pair of leggings sells for, $100, $120, but costs maybe $20 or $30 to make, that massive margin, that 59.2% gross margin they just reported, is fundamentally protected by that technical superiority. And beyond that, the growth strategy, this Power of 3X2 plan to double revenue to $12.5 billion by 2026, is actually, I think, de-risked by how well they're executing abroad.
Total international revenue was up 34% last year. China mainland surged 41%. This proves the brand's lifestyle pitch isn't just a North American thing. It translates globally, giving them a huge runway for growth that's, totally separate from the more saturated U.S. market. And with a fortress balance sheet, zero debt, $2 billion in cash, they have the money to fuel it.
See, the problem with leaning on historical margins is that they are, right now, eroding pretty quickly. The core risk for a long-term investor here isn't just competition, it's the speed with which consumer tastes can shift and just destroy that pricing power. We are seeing competitors like Alo Yoga and Vuori. And Vuori, by the way, just reported a 23% sales jump and hit a $5.5 billion valuation. They're aggressively capturing that same customer. These brands show that Lululemon's technical edge is not, insurmountable. But the most glaring evidence that the moat is in trouble is in their own financials. The slowdown in the Americas, which, let's remember, drives the majority of their revenue, is critical. America's comparable sales decreased 5% in the third quarter. You can't hide that core weakness behind strong international numbers forever. And the margins are showing real stress. Operating margin down 350 basis points, gross margin fell 290, and management said it themselves. This was because of higher tariffs and, more importantly, increased markdowns. And markdowns are the clearest possible sign that you're having trouble moving product at full price. It directly attacks the whole idea of a moat.
Okay, let's address that margin pressure because it gets to why the innovation is a durable moat, not just a temporary edge. You say the fabrics are replicable, but the moat isn't just one patent. It's a whole system. Their R&D process, it involves this incredibly rigorous quality control. Every single fabric lot goes through 13 to 15 different quality tests. That kind of consistency at scale is what competitors find so hard to match. It's more like Coca-Cola's proprietary process. The value is in the whole chain, not just the secret formula. And on top of that, their vertical retail model is maybe the strongest structural defense they have. Over 90% of their sales are direct, through their own stores and website. This gives Lululemon absolute control over the brand, over pricing, over everything. It prevents the kind of brand erosion and margin dilution that wholesale brands like Nike or Adidas face
when their stuff ends up on discount racks next to cheaper brands. This control is what reinforces their premium status, and it lets them recover from, say, a temporary markdown much faster than anyone else.
I appreciate the analogy, but the difference is that apparel consumers are not necessarily brand loyalists when an equally good, cheaper alternative comes along. The barrier to entry for polyester spandex blends is, let's be honest, incredibly low. We've already seen Nike's One Tight leggings, which look and feel a whole lot like Lululemon's. And then you have this whole dupe culture on Amazon, selling high-performing stylish items for $30. That puts enormous pressure on the perceived value of a $128 pair of leggings. And the quality argument, which is supposed to be the entire foundation for that premium price, is also showing some cracks. I mean, you can find persistent, anecdotal complaints online about declining quality, pilling on certain fabrics almost immediately. If the physical durability isn't there, the justification for the premium it dissolves into fickle brand prestige. When your gross margin drops almost 300 basis points because of markdowns, that tells me consumers are already voting with their wallets. The moat is shrinking under pressure.
But dismissing a 5% comp decline in the Americas as a structural failure of the moat, I think that ignores the massive strategic potential of their global success. The long-term durability of Lululemon it's intrinsically tied to its ability to capture the global middle class, especially in Asia. The international growth, led by that 41% revenue surge in China, is proof that the brand's whole lifestyle thing translates culturally. They're not just relying on some imported Western prestige, they're actively building local communities. They hosted the Summer Sweat Games for 10,000 people across 40 cities in China. This kind of local approach confirms they have the engine to hit that ambitious $12.5 billion target, focusing only on the mature American market, which to me looks like a short-term execution problem, ignores the huge runway they have internationally.
Right, but that assumes the foundation isn't cracking too badly to support the rest of the building. The U.S. market is still the majority of revenue. A sustained 5% comp sales decrease in your biggest, most mature market is not just an execution error. That strongly suggests you've either hit saturation or there's a fundamental consumer shift away from your brand. If your core customer is trading down or switching to Vuori, that's a systemic problem with your value proposition. And furthermore, relying so heavily on China, which is now 13% of revenue, introduces some significant geopolitical instability. Lululemon's supply chain is heavily outsourced, with 42% from Vietnam and 16% from Cambodia. This geographic concentration makes them extremely vulnerable to margin hits from changes in trade policy, especially if the U.S. gets rid of the de minimis exemption.
If tariffs go up, those already compressed gross margins are going to get squeezed even tighter. And that $12.5 billion revenue goal starts to look a lot less profitable.
I agree. Geopolitical risk is a real factor, but management is proactively addressing this, and they're using tools that actually create an operational moat. They are actively integrating AI into the entire product lifecycle. And AI isn't just, designing things faster with generative tools. It's being woven into sophisticated inventory management, merchandise planning, and store clustering. This use of predictive analytics lets them anticipate demand with way more precision than their competitors, which allows them to pivot quickly and minimize the very markdowns you're pointing to as a sign of weakness. And that's an example of strong operational discipline. Just look at the inventory. Yes, the total value was up year over year to $2 billion, but management was clear that on a unit basis, the increase was only 4%. So that suggests very disciplined, targeted investment in new styles, not just bloated warehouses full of old stuff.
That operational agility is a huge counterweight to the macro pressures.
But operational agility is useless if you don't have stable leadership to steer the ship. And the most acute near-term risk that just completely undermines the 10-year durability thesis is the management flux right now. For facing a major strategic vacuum, the CEO is leaving, and they've installed interim co-CEOs. That kind of transition creates instability at the exact moment you need a clear, confident strategy to reverse that negative comp trend in the Americas. And this internal uncertainty is being made so much worse by external pressure. You have activist investor Elliott Management building a massive stake, pushing for their own CEO candidate. At the same time, you've got the founder, Ship Wilson, pushing for changes on the board. A long-term value investor needs to have confidence in stable governance and a clear strategic plan. And right now, Lululemon looks paralyzed by internal conflict and external demands, which is preventing them from fixing their core market.
Thesis still rests on its structural advantages. It has a vertical retail model that guarantees brand control, and it has proprietary innovation that justifies the premium price. The explosive, culturally validated international growth, that 41% surge in China, it proves the brand's global potential. The U.S. decline, I think, should be seen as a temporary challenge that technology and, the appointment of a new, strong leader will resolve. It's not a structural failure of a moat they've spent 2 decades building.
For an investor focused on durability, I think the structural fragility is just too great. The combination of sustained weakness in their dominant U.S. market, that 5% comp decline, plus ongoing margin compression from markdowns and trade risks, all happening while the company is navigating a high-stakes leadership crisis, it makes the brand's 10-year durability highly questionable. The core problem is still there. Their premium price relies on a moat that is just demonstrably easier for competitors to cross than, say, Nike's R&D budget or Costco's scale.
So the central issue for any investor, really, is figuring out which factor is going to be more powerful over the next decade. Is it the established brand loyalty and the technical superiority, which is protected by that vertical model, or is it the accelerating risks from competition and market deceleration, all happening under a leadership team that's in transition?
Exactly. And the path forward hinges completely on who they pick as the new CEO. That person's first job has to be articulating a strategy to reverse the slide in North America. They have to prove that this is just a temporary dip and not the beginning of a long-term erosion of the brand's power.